Hey all, this is Nima, and we want to thank you for tuning in to the Z Investor Talk. We also want to give a big thanks to Jim Leitner for coming on, and we hope to have you on again soon. Make sure to like and subscribe, turn on notifications so you get notified for our next talk and video, and thanks for watching, guys. So, hi everyone, my name is Nima. Welcome to the Z Investor Sit Down, and today I'm really pleasured and grateful with the opportunity to talk to Jim Leitner. He's considered one of the greatest macro investors of all time and a legend amongst traders on Wall Street, being able to pull billions. He's currently serving as the president of Falcon Management. Jim, it's a pleasure to have you.
Hey Nima, I love being here. Thank you for asking me.
That intro probably didn't do enough justice to you. So could you probably give yourself a bit more background information or talk about yourself for a bit to our audience and describe your journey and path of trading, investing, and whatever else?
Sure. So I grew up very international. My great-grandparents went from Austria to Turkey as missionaries and as plumbers. One of my great-grandfathers built the Sultan's first plumbing, his first flushing toilet. So I had family that ended up in Turkey, and I lived for 5 years in Istanbul when I was a little boy, from age 6 to 11. And then I lived in Germany, and I finished high school in Germany and came to America to go to college. I grew up speaking German. I spoke also some Greek and some Turkish because I was surrounded by many Greeks and many Turks at parts of my life. And, I always was interested in international. I always felt that the world's a big place, there are lots of exciting things happening. I'm super curious. There's really nothing that doesn't interest me. If you give me a good book about anything, whether it's art history or philosophy or a novel or a book about finance, I just find it fascinating. And I think I always wanted to end up in a field where you did interdisciplinary studies. You could think about lots of interesting things. I used to think I would end up in a diplomatic service and somehow go to embassies around the world and learn foreign languages and be a diplomat. And then I got a degree from Yale in economics and a master's in international finance concentration from Columbia. And I started a job on Wall Street just because I needed a job.
Sorry, if I can cut in. Some people I've talked to before, they've mentioned that their finance degrees kind of meant nothing to them, or they didn't really enjoy getting them. Was that something that, I don't know?
Definitely true.
Really?
Yeah, it's definitely true. It wasn't very useful. It just kind of helped, I guess, initially to get the first job. I was working for the dean of the School of International Affairs at Columbia and getting paid $3 an hour. And I thought that wasn't enough to live on. So I best find another job while I'm in school. And I applied to be a money broker trainee on Wall Street. And I got that job and I got paid $5 an hour. So that was a huge increase. And I was still at Columbia. I had another year to finish my degree and ended up then working full-time as a broker, but realized being a broker is no fun because what you're doing is just executing other people's orders. So I went from there to a bank, to JP Morgan, to find out, where do these orders come from? Why are people doing what they're doing? And I became a trader. I think having an international background helped. Speaking German helped. I was able to talk my way onto the currency trading desk when we had a German-speaking chief dealer. And I learned currency trading at JP Morgan. And from there, I went to other banks. I went to Bank of America. I went to Lehman Brothers. I went to Bankers Trust. And finally, I realized that, most of the trading is driven by the ideas you generate. There are two types of trading when you're at a bank. One is just executing orders for customers. A customer needs to sell some currency for their import or export needs. They're getting paid in the foreign currency, they need to sell it, they want dollars, you just execute the trade. And then, of course, there was a risk-taking side where you could decide, I would like to own yen, or I'd like to own a small currency in Europe. In those days, we didn't have a euro yet. We had all the little currencies like Spanish pesetas and Italian liras and Portuguese escudos. And it was kind of fun to trade all of those currencies and figure out how they related to each other and how much they could move against each other. It was a great learning experience. And as I did that, I realized that, if you have ideas, you don't really need the whole banking network structure behind you. You could just go and invest using those ideas. And I started Falcon in 1991 and have been, investing more or less since then. Sometimes with more success, sometimes with less, but it's been a fun and exciting ride.
Yeah, we can all relate to that part of more or less like when you get started. Sure, you may start off with some success. You may get lucky, just like buy in a bull market, but it's always going to come back and try to teach you a lesson.
Yeah, I mean, I think lesson number one to me was always not to have hubris, right? Just to realize how much luck has to do with this, how lucky we are to be in a spot that gives us the opportunity to take risk, to scale our ideas. In many jobs, you're selling your time. You're a lawyer, right? You might work and get paid a lot of money per hour, but you just can't work more than a certain number of hours. At a certain point, you just are exhausted. As an investor or trader, you can scale your ability much easier. Instead of selling 5 million euros, you can sell 50 million euros. Or if you're working for a large fund, 500 million euros, except that your outcome can be magnified tremendously. And, that's one really nice part of being in this business. And the other part I've always really liked is the interdisciplinary nature of it. That there is input from so many different areas, whether it's politics. Oh, there's an election. What does that mean? Is it good for the country? Is it bad for the country? What type of policies does a new government want to pursue? Is it going to have an impact on the stock market? How is it going to be perceived by other investors? Right? That's about the political system. That's not about, how is a certain company doing? So politics play a role, history plays a role, psychology plays a role. Like, how are people thinking about the world? I mean, take COVID. Initially, no one was that nervous about it. The little rumors in the papers and things were kind of a little bit less stable, but stock markets kept going up. Things looked okay until people suddenly got nervous, changed their mind. And then suddenly things fell apart really, really quickly, right? So the decline that we saw happened with a speed that was much larger because you had hit some kind of tipping point. And these kind of psychological tipping points are interesting to observe and interesting to try to be on top of rather than always forecasting them. Just being there and capturing that wave is super important and trying to be slightly better at investing.
Yeah, definitely with COVID. Definitely with COVID, because there's not speculation, but there's so much just media coverage and different opinions and just a bunch of knowledge that you have to manage at once in order to, because you have to be able to stay sane if you want to invest, if you want to continue to actually make money. Otherwise, you'll be selling when people are selling and losing your money, or buying when people are buying and buying at the wrong time. But yeah, that's definitely a really important part. That's psychological tipping points.
Yeah, I think, having some kind of equanimity, being relatively calm about your portfolio is super important. And, you can do that in different ways. Number one, you can do it by having a quite diverse portfolio, so you don't have everything go wrong simultaneously. Number two, you can do it by having a long time frame. Like if you look at the market all the time, every day, you're going to see a lot of volatility, right? There's a lot of times when you're down money, then you're back up money, and then you're down again. And if you allow that volatility to affect your thinking, you're going to start making bad decisions. So, part of the advice I have is to focus on the end game. Like, where am I going? Like, why do I own this portfolio? Where do I think it's going to go over time? What are the drivers? And really just think about, have the drivers changed or not? And having big picture ideas, I think lead to investment success much more than constantly trading and trying to capture the thing that's starting to move. And being on momentum might help you occasionally, but as a trading strategy to every day be involved in the thing that's just starting to move the most is really hard. And you're competing on a time frame where the algorithmic traders, the computer traders, will clearly be faster than you can as a person. So, where you need to have an edge is by reflecting and thinking about the world and saying, what are the kind of things that I can forecast? And how are they going to impact the world? And, I realize, for example, that not everything is built into prices. I mean, under the efficient market hypothesis, all information should be in the price. But really know that can't be true. I mean, there's that Grossman-Stiglitz paradox that says markets can't be efficient because then nobody would spend the time to try to have more knowledge, because that would be wasted time. It would be a wasted cost. I mean, if the markets are perfectly efficient, then why would you spend any time trying to figure out the market? Right? The market becomes efficient because you are spending time and you're buying things that then turn out to have good value and over time move higher. And you've done the research and you help make the market more efficient in that respect. So I think that having a longer time frame, like an end game time frame, not with an exact, it's got to happen in 3 years, or it's going to happen in 5 years, but like, what's the big picture? So take something like fintech versus the banks, right? If I give you two choices today, would you rather own fintech for the next 10, 20 years or banks?
Well, right? You have to think about it. Yeah. You have to manage, like, which one's more growth, which one has the better past or whatever. And
right. And if I think about it, I look at something like, like PayPal has a market cap of 330 billion and Bank of America has a market cap of 330 billion. Which one would I rather own for the next 10 years? And, in my view, I'd rather own the one who is the aggressor and who is trying to steal the best part of the bank's business. Right? Like, a bank makes money on payments. A bank makes money on loans. A bank makes money on, different like cross-border payments. Well, PayPal can zero in on those exact activities where you make money and move them out of the banking system and say, hey, we can do that for you and we'll charge you less. We'll make that payment at a much lower cost than Bank of America will. And they can do that they have 20,000 employees and Bank of America has 200,000 employees. So like in terms of cost structure, somebody like PayPal over time is clearly going to have a better return per person working there, right? It's going to be more value accretive. And, I think that technology is driving out the inefficiencies in old industries. It just takes time. It's not something that's built into prices perfectly today. The market, yes, values PayPal and Square higher than they value banks. But, over 10 years, 20 years, I think people just haven't yet seen how much these fintechs can take away from the banks and how difficult it will be for the banks to compete. So, I would rather be long fintech. That's an end game. I'm in that trade, not because I have a forecast exactly where Square is going to be or where PayPal is going to be, but just that, if I had to make a choice between those two, I'd rather be in Square and PayPal than Bank of America and Citibank.
So
yeah.
So like when you're trying to pick up stocks on your radar per se, or like comparing them between different, I don't know, this is just the example you brought up, but different like similar industries and competition between the two, you'd rather go into the one that you feel like is sort of competing in a different way in terms of models
and has a technological advantage. Like they don't have an overhead built in that makes it more difficult for them to really change the whole infrastructure. Like it'd be hard for a big bank to really change the infrastructure. You know, how many people do they want to let go? How many branches do they want to close? You know, there's been already a lot of improvements on the banking side, but there's still plenty to go that the Squares and PayPals are just nibbling away at. You know, so Square, I presume you've seen it, where merchants have a Square, not like a cash register, but just like an iPad, and you can pay using your credit card. Well, friends of mine own a store in town and say, well, Square's already offering us loans. And they know exactly what our payments history is, how much money is coming in. They have better data than the banks do in that, you know, they see every transaction that's going through our cash register. So they can actually give us a quote on a loan that they feel very certain about because they can model our business better than the banks can. That better data and more timely data. They see exactly, you know, like every day, this is what's happening in terms of cash flow. So, you know, I think it's a good example in terms of having a longer term time frame. It's not exactly as important to say, well, I bought Square when it was really, really cheap. It's more, you know, is Square going to be a winner over the next 10 years?
Yeah, that's what that's what I feel like a lot of people get wrong in the market nowadays. They try to time it. Like they try to say that if you buy it at this point, you'll make money. Rather than timing the market, they should, I feel like, more time the growth of the company and whether or not like over time it'll become better. This kind of leads me into another question. Like, I bet the market was really different when you started trading than it is now. So, and specifically, especially with like what I was talking about, timing the market in terms of how like overpriced some stuff is and valuation can be very hard to calculate and super high. Is there any way to sort of approach that now in the environment we're in now, where like you can actually buy something low and sell high rather than buying it at an all-time high right now and trying to ride it out for the next 10 years?
You know, it's a really hard question. I mean, if I see something that's low and it's starting to go up, it makes me think about, well, why is that happening? It also leads me to tell you about a position I have. For example, I'm long Cameco, which is a uranium producer. Now, why am I long Cameco? Why uranium? Well, uranium prices were significantly higher early in the century. So 2005, 2007, uranium prices were much, much higher than they're today. Today, they're down at like $30. They bottomed out around $20 and they just started going back up. Now, why might uranium be interesting? Well, you know, we're talking a lot about climate change and what is going on in the world, and we're talking about greenhouse gas emissions. Electricity usage in the whole world is not going down. Like we're going to have more people over time, we use more energy. It happens. How are we going to create this energy? Well, solar is becoming cheaper and cheaper, which is wonderful, and wind energy is becoming cheaper and cheaper. That's wonderful, but they're not super reliable. Like, you know, at night you can't run solar. You don't know exactly what's going to happen with the wind. People don't want 1 million windmills around their town. So when you look at the alternatives to have a base load, nuclear doesn't look bad. Right? France generates 75% of the electricity from nuclear. Wow, that's a lot, right? And we've never heard of an accident in France, people getting nervous, it blowing up. It doesn't happen. You know, people are nervous about nuclear because when there have been problems, it gets really exaggerated in the media. Now, there have been some cases like in the Ukraine, when there were real problems on an old nuclear power plant. But compared to something like how many car crashes do we have in the world every day with people dying, and nobody talks about, oh, we're going to just stop driving. Right? We've had many fewer people be affected by nuclear power plants than by the auto industry or by the greenhouse gas emissions or the particles that you inhale over New Delhi or in Bombay or in Toronto. The air is getting dirtier.
I don't think we have nuclear energy here. It's mostly hydro here. But
right. Well, I agree. We have a ton of hydro in Canada, which makes it very attractive for, greenhouse gas emissions are zero with hydro. It's fabulous. But, you don't have hydro every place in the world. So in the place where you don't, they're going to be building more nuclear power plants. It's just a matter of time. There are already, 50 or so on the drawing boards, something like 16, 17 in China, in India. There are clearly new nuclear power plants being built. Well, they're going to need uranium, and uranium prices over time will probably go higher. Now, when they go higher next month, I don't know. I doubt it. But, over 5 years, I have a feeling they'll be higher. And so, I think it's important to not worry so much about the path, but kind of think, is there going to be more demand? Yes. How easy is it to add new supply? Well, it's pretty hard to actually open a mine. It's not that easy. It takes a lot of capital investment. It just doesn't get done, right? So there's going to be pressure on uranium prices to, over time, go higher as new nuclear power stations get opened. And, if I look at something like CCJ, Cameco, which is kind of one of the world's largest, outside of Kazakhstan, uranium producers. At the price where uranium is now, they make a little tiny bit of money. But if the price of uranium went up to $50 or $60, they would make a lot of money because their costs wouldn't really go up very much. Right? They'd still be doing the exact same mining. Yeah, there's going to be some inflation over time, but over 5 years, how much inflation is there going to be? So, in our modeling, we see that CCJ, if uranium went to 50, CCJ could be at 40. Well, so we started buying it around 9.
Got it.
Could it go to 0? Yeah, I mean, the whole world something bad could happen and Cameco could, have a real problem and go bankrupt. Is it likely? It's very, very unlikely that would happen, right? And today, Cameco is like 17 and a half. It went as high as 21. We started buying it, I don't know, like 9 months ago, maybe a year ago. And we don't have an exact time frame. It's not like we're saying, oh, like if it gets to 30, we're going to sell it. It's more, well, let's see how many nuclear power plants get built. Oh, is there a new one on the drawing board? Oh, is there new technology that people can start thinking about smaller plants and then build more of them and distribute the energy better? And the other thing we look at consistently is optionality. So we think that options can give you really exaggerated returns because you put up so little, right?
Yeah.
So basically when Cameco was at like 10, 11, we were buying call options for 2-3 years, struck at 17 and at 20. And then when we got to 21, we sold the ones that had the 17 strike and made 300%. We paid $1.70 and sold them for $5. Now, if we had just bought stock when that happened, we would have only made like 80%. Like if we bought the stock at say 12 and then it went to 21 and we sold the stock there, we would have made $9 on the base of 11 or 12. So options can give you that extra upside exposure. And, we're always looking at long dated options. So we're not trying to guess that, Cameco is going to go up next week or next month, or they're going to have really good earnings. No, it's really, we believe over time, this is going up. Okay, what's the longest dated option we can find? Oh, it's for about 2 years. Okay, then we'll invest a little bit of money in that because we think over 1 year, 2 years, 3 years, that stock will do better.
You touched on.
We do the same on the whole market too.
Yeah.
Sorry, go ahead.
No, it's okay. Yeah, you touched on like risk there a bit, like how there is some aspect that this company could go down, like something could bad happen. Like it's really cool that you focus more on what is being done externally and like worldwide to what this company is doing, rather than just looking at like space, like looking at uranium prices. But something could happen that could make the company like go down. And then you also talk about like options and stuff when the upside is very exaggerated, but also the downside is also very, very exaggerated as well, as we all know. So like, do you ever like manage that sort of risk somehow, both like, I don't know, mentally and fiscally?
Yeah, I mean, when we start out, we never allocate more than 10% of our capital to any one idea. Because if we were totally wrong and it went to zero, we would lose 10%.
Yeah.
Right? And would that make us happy? No. But would it change my lifestyle? No. I'd still do what I do. I love what I do. And that's fine. So, this is how we kind of approach Bitcoin. Like,
it's like money you put in that you can lose. Like,
yeah, exactly.
Yeah. Okay.
But I think about it quite systematically. Let's say, what does it mean, money that I can afford to lose? It's just what percent of my net worth am I willing to see go to zero? So in Bitcoin, I did not get involved with Bitcoin in the days when it was really cheap. When it was like $80, $100, because I just didn't understand it. I didn't know what was going on. But I started buying it in 2019 when it was $8,000. And I said, okay, it can just go to zero. I mean, it could just go to zero, could just go away. Governments could decide that you can't own Bitcoin, or this whole mining thing, there could be a 51% attack and they could change the blockchain, or who knows what could happen. And I thought about, well, how much money would I be willing to lose if it went to zero? And I said, well, I'll take 3% of my net worth. And if it goes to zero, all right, it won't be good, but it won't be a terrible, terrible year. I'll lose 3%. And then, it went from 8,000 to 64,000. So it was up like eightfold. And suddenly it was like 24% of my net worth or something. And
there you go.
And, I normally wouldn't want to sell anything, but I sold a little tiny bit. Whoa, sorry about that.
That's cool. Your dog got excited when you said you sold it. So there you go.
Tiny bit. I only sold about 10% of it. The day that we had the Coinbase IPO. Because when we had the Coinbase IPO, it was kind of like, now everybody knows that these cryptocurrencies are good and important and there's something going on.
Yeah.
And, I've not really traded much more since then. I mean, it's come down about by 50%. And, now it's only up fourfold. So would I have done better if I'd sold it all up there? Yeah, I would have done better. On the other hand, I'd have to pay taxes. In a after-tax world, you're kind of better off just owning something that over time will go higher, you hope. And also it gave me time to start thinking more about this whole crypto market. What does it mean? Like, once you have a foothold, once you invest, first you do some research and you decide, okay, this is worth, it could go up. I don't think that you can really know everything about it. I'm not a big believer that you're going to spend 100% of your time trying to learn everything you can about crypto. I'd rather spend 20% of my time and learn 50% of what's important about crypto, and then use the other 80% of my time to learn about, fintech, and learn about nuclear, and learn about, the Russian ruble or the Brazilian real. And so I will spend time on it. But then if you have an investment, you start learning even more, because you start saying, this is interesting. I'm wondering, like, what will happen in 20 years when Bitcoin halving has happened 5 more times, and now people are getting paid a tiny amount to keep building the blockchain. Is it still going to be worth it? I don't know. Like, maybe Bitcoin's not such a good cryptocurrency. Maybe they're better ones. And so I'm learning about new ones like Ethereum and Cardano and Solana, what's it called? SOL is the ticker, and Polkadot. And every day I kind of go, well, there's something new I can learn about crypto, and I start learning more. And that's why I'm reading the book.
yeah. I feel like when you first, like, I don't know, if I see a stock or something, or some sort of asset, crypto, whatever it may be, and I'm interested in it, I do my research in it and I get hooked on it. I learn more through the actual experience of holding it and seeing what happens throughout, like, the time of holding it and being an owner of that asset, rather than actually initially doing my research on it. Like, I could look at a stock and I could say that I find it good growth, undervalued, and like the operations are completely fine, and I could buy it and I can hold it. But I'm only like buying it at that time to guarantee in the future that I will make a profit, or that I'll be happy with that investment. So I feel like that period of actually like holding it and seeing, like, learning during that. I feel like when you mentioned that you learn 50% about crypto initially, maybe the other 50% is learned through actually owning it and seeing what happens. So yeah.
I think that's true. I think when you own something and you have skin in the game, as Nassim Taleb says, you wrote a book called Skin in the Game. It makes a big difference. Your attention doesn't flag as much. You might read something and really pick up that. So for example, JP Morgan sent out a weekly, just an update on cryptocurrencies. And I was thinking, you know what? That's really interesting that a major bank would be starting to send out a weekly update. That means a lot of people are thinking about cryptocurrencies. Like a long time ago, a year ago, 2 years, a long time ago, well, 2 years ago, how many people even knew about cryptocurrencies? Probably 7 or 8% of the world.
Well, here's the funny thing. Everyone knew about it in 2016 and 2017, but then completely forgot about it in 2019, 2020. So it isn't even that notion that like it's that like people are huddling towards it. I don't know, just like media coverage and all that hype, I guess, kind of pushes that as well. But yeah, go on.
Yeah, no, I kind of think that, as you're holding something, you definitely learn more about it. And, and you pick up things like this, that, like, why would a big bank be putting out something? It's not even specifically that there is something in the blockchain that you want to learn about, or, difference between proof of work and proof of stake, and, like all the new kind of ways of stabilizing blockchains and verifying transactions. It's more about, interesting. I wouldn't have thought that a big bank like JP Morgan would be sending out a note about crypto. And they have millions of customers. How many people get to see this kind of stuff? And it just makes me think that we're just at the beginning of the adoption curve. So now I should spend a little more time on it. And then the question becomes, is Bitcoin really the best thing, or do they just have a first mover advantage? Like, how important is Ethereum? Like, if you had to build a business, would you build it using Ethereum blockchain or a Bitcoin blockchain? Or would you use a totally different one like Polkadot or Cardano? Like, there's always something new to be learned. And I think that's what's fascinating about the trading business.
Like, I feel like the times I learn the most is when I lose money, because that's when I'm like questioning stuff and want to know more about what went wrong, like, or whatever else happened. I don't know. So yeah, that's pretty interesting. Just in general, like the experience of like keeping up when you initially decide that, like, all right, I'm going to stick with this. I'm going to see what happens. So yeah.
I think you're right with, you learn the most when you're wrong. because you tend to get intellectually a little bit lazy when things are going your way. And the other thing that we as humans tend to do is we are innately looking for confirming evidence. So when, let's say I like something, I like the Chinese currency. I think the Chinese currency should be stronger. And, you know, I have a reason that, you know, if I were the Chinese government, I'd want to be less export dependent because I never know. I can't control the rest of the world as well as I can control what's happening domestically. So I'd prefer if the domestic economy were larger and there was more consumer demand and there was more going on just inside of China rather than in the export markets, right? So one way to do that is just to kind of make the currency a little bit stronger because it creates incentives for the exporters to become better because it's harder for them to export. And for domestic players, it means that they're worth more. They can import cheaper because their currency is stronger. You know, they can spend more money domestically on becoming efficient. You know, I think that they have a view that they would like to internationalize their currency. They would like foreigners to buy Chinese government bonds. That makes perfect sense. Why not? They should. They would like foreign central banks to be using Chinese government bonds for their reserves. Makes perfect sense. They would like capital inflows in order to deepen their own capital markets. Okay, so I have this idea that China wants a stronger currency, but not in a rush. That, you know, over the next 2, 3, 4, 5 years, the currency will strengthen. But what I really need to focus on is reading somebody's paper that says China is going to actually devalue their currency, or you know, there is this really big risk in the Chinese high yield bond market that's buried and people haven't focused on enough, and that companies are really mismanaged and not well supervised, and therefore there's a lot more risk in the Chinese market than we know about. Because I will tend to read the things that say, oh, you know, things are working out okay in China. The capital inflows are coming because Chinese 10-year bonds yield 3%, and in America, our 10-year bonds only yield 1.3%. You know, in Europe, 10-year bonds yield negative rates. So, you know, Chinese bonds at 3%, that's a pretty good place to put your money, as long as the currency stays stable or even appreciates. So, you know, as I'm reading, my eyes tend to be drawn to confirming evidence. And it's really important to push yourself to read the disconfirming evidence, because that's what you should deal with. You know, if you can kind of see that, yes, there is something that's wrong, and then evaluate whether it's strong enough for you to change your mind. That is an important part of being good at, you know, longer term investing, because there's always going to be conflicting evidence. Otherwise, the price would have already dropped, right? I mean, there's going to be some reason why the price is, I mean, the dollar China will have dropped, so the Chinese currency would have already strengthened. But there must be some reason why it hasn't happened yet.
Yeah, like, I don't know, both in life and just in investing in general, it's really important to stay humble. I don't know, really important to just either take the loss and learn from it, or either figure out what you got right and apply it the next time. I don't know. So
what you got wrong.
Yeah, exactly.
What you got wrong. Exactly. So I think being humble is super, super important, and not falling in love with your ideas. You know, not thinking that, oh man, I'm like 95% certain that this is going to happen. Yeah. You know, there's always times where you think you're going to be right, but you're not ever super, super, super confident that you're right. You know, things can change, and you have to just stay on top of it. And you have to keep reading and thinking and talking to people and getting other people's input. And, you know, lots of people out in the world who are way smarter than we are. And it's great to be able to reach out and try to learn from them.
There you go. This is what's happening right here. It's just talking to you. So yeah, I'd have people come up to me and say, like, Nima, this stock, there's nothing wrong with it. There's really nothing wrong with it. I've done all the research. I've done everything. And I feel like it's like just like that external viewpoint of me saying like me going over it and not being blinded by that, not ego, but just like being really stuck to this idea, not like being bounded to it. It's really important. So yeah, but you bring up another good point about like you have to go on and you have to like just assess from there. And like just talking to you, you've been to all the corners in the world. You've been investing in corners of the world, and it must be really hard to manage all that knowledge, or at least like apply the important parts. So how do you sort of do that? Like, I don't know, whether it be through looking at an asset like stocks or currency or crypto, how are you able to like filter the important knowledge you need to know without getting all that clutter in your head and confusing you? Because I feel like a lot of people struggle with that.
Well, I think there's a wonderful book called The Checkpoint or The Checklist Manifesto. Checklist Manifesto by Atul Gawande. He is
never heard of him. Yeah.
So he is a doctor, a surgeon, and he was hired by the World Health Organization, I believe, to go around hospitals around the world to try to figure out how you could reduce mistakes. Why are there bad surgeries? What happens? And at the end of it, he figured out that the easiest way to improve performance in surgeries around the world was to have a checklist. Just have a little checklist next to the door where, you know, every single thing had to be checked off. Like a nurse would check, you know, did we give an antibiotic within 90 seconds before the operation starts the patient? Yes, check. Like, did we make sure we are operating on the correct arm? Check. You know? And if you did that, suddenly hospitals that introduced that checklist made massively fewer mistakes. I mean, the outcomes were incredible. And I think having a checklist like that for your investing makes perfect sense. So in my checklist, what I'll do is I'll say, okay, I have this idea. Well, the first thing I need to do is figure out what's the expected value of this idea. So let's say I think the Chinese currency is going to go up. Okay, well, how certain am I? 0.6, like 60% certain. Okay, so at 60% it goes up. Well, how much is it going to go up over the next year? Okay, 5%. Okay, well, if I'm wrong, 40%. How wrong am I going to be? How, you know, and once you multiply those out, you have an expected value, right? You can calculate what is the expected value of this idea. And you only want to invest in positive expected value. So, you know, take the probabilities times the outcomes, and, you know, you can be as fine as you want. You can have, will it go up, will it go down, or will it go up a lot? You know, you could have 5% for it'll go up a lot, and you could have 60% for it'll go up somewhat, and you could have like 5% it will collapse. I'll be totally wrong. You know, they'll invade Taiwan, and oh my God, the Chinese currency will just fall apart. And then you can have the balance on, you know, it'll go down a little tiny bit. And then you can multiply out the probabilities times the outcomes, and you sum that number. If it's positive, you have positive expected value.
Kind of like an algorithm, basically.
Yeah. That's step one. That's step one. And then step two is, well, if you have positive expected value, how big a position should you take theoretically? And for that, you know, I use something called the Kelly criterion. So there's a math kind of approach to gambling that's called the Kelly criterion. It tells you how big you should gamble when you're playing blackjack or when you're investing, and when you know the probabilities, or when you think you know the probabilities, because they're estimates, obviously, right? And then I write down what is the reason that I think there's positive expected value. Like on the Chinese currency, I might say, you know, they want to make sure that there is a stronger currency because they want internationalization, and they want, you know, the economy that's not only driven by exports, and there's positive carry, so foreigners are going to want to put their money into the Chinese bond market. And, I might make a little list like that.
Yeah.
And, having a little checklist for the trades, I think helps keep you focused on why do you want to do this trade, right?
Yeah.
And then over time, what you need to do is keep track of it and say, well, have the probabilities change? Like, let's say you were right and you started investing the currency when it was at 7.00 CNH to the dollar, and now it's at 646. So the currency got stronger. It takes fewer currency units to buy a dollar. Well, is it still the same probabilities from here? It's already moved.
Yeah.
Like 8 or 9% in your favor. Right? So now you should be redoing this as new information comes in. So as prices change, you have new information. As politics change, you have new information. For example, during the trade war that Trump had with China, how important was that? Was that going to weaken the current? Were the Chinese going to use that to weaken their currency to make up for tariffs? Well, I don't know. You have to start thinking about that. And when it doesn't happen, when they didn't weaken their currency, that was a very positive signal because they didn't use their currency to counteract some of the Trumpian policies that were being thrown at them.
Yeah.
So I think, having this little kind of checklist makes really good sense. And reading the Checklist Manifesto by Atul Gawande, great book for summer reading.
There we go. That's going to be on my read. Yeah, I guess you can always have a checklist for whether you want to buy, checklist for whether it's good to hold, checklist if it's whether it's good to sell. That's interesting. I feel like I've had like pillars, not a checklist per se, but kind of like that. But it's a more interesting and I guess more intuitive way to put it. So yeah, that's really interesting. Thanks for that. Yeah.
And the other thing is there's a good book called Super Forecasting by a guy named Philip Tetlock, who with a team of people won the forecasting competition for something called EARPA, which is like DARPA, the Defense Agency Research Program, something. EARPA is for the intelligence agencies, their research program. And they had a competition for forecasting. And how did he do it? And this book explains how you look at assigning probabilities to everything. Rather than thinking about, it's going to happen or it's not going to happen, things are always probabilistic. Like there is a 65% probability that blah, 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 whatever you're trying to forecast, right? And as new information comes in, you move that. You go, it makes it more likely. Oh, no, it makes it less likely. Like as new information comes in, you move your probabilities. And that, of course, ties in with calculating the expected value on those ideas.
Got it.
So that's another good book to read, and it's also great beach reading. Super Forecasting by Philip Tetlock.
Super Forecasting. So you're just making sure that ideas are just not upheld, I guess, but continue to stay like prevalent through that checklist. I don't know if I'm like wording it right. Yeah.
And you keep updating your probabilities. You keep updating. You start out by saying, I've read all this research and I'm very sure that Chinese currency will appreciate. 70% sure. Okay. So I'm 30% not sure that, the 30% that it could actually go down. And then, as more information comes in, I might say, I'm actually 72% because like during this Trump period when it could have weakened, it didn't weaken. So that's kind of a statement in favor of they actually are not going to use a currency to, help the exports.
Got it.
So I think that's an interesting way to think about your investments, but I think it's also just a good way to think about any kind of decisions you make in life. You have checklists, you think about it, and you make checklists for different jobs that are different.
Yeah, I guess in like life, investing, whatever it may be, if you're doing work, if you're freelancing or whatever, but whatever it may be, it's those values you hold that either set you apart from everyone else and can either ruin you or push you forward. So just a checklist for those values, checklist for if this company, if this asset, if this currency is aligns with those values, if I feel comfortable with that. So I mean that yeah, anything in life you can use a checklist for.
Yeah, I mean you can use a checklist for when you have to do your English paper next year.
Yeah, sure.
Right? You're like, have I done? What's the research I need to do?
Yeah.
Like, what kind of articles am I supposed to look at? How many books am I supposed to have on it?
Yeah.
Do I have a theory that I'm going to be writing about? What's my thesis statement?
Yeah.
It's the same thing. Having a checklist, I think, helps you stay more focused on the process. And process is really important. It's not always the outcome that matters. It's also how did you get there, and can you replicate that in a different scenario, a different situation. The other thing is, I think that the power of compounding gets underrated. Like if you're a good student and every day you're learning 5 new words of French or whatever foreign language you're studying, after a year, you'll learn an extra 1,500 words. And if you do it for 2 years, you suddenly have 3,000 more. But once you have 3,000 more, you're suddenly talking to more French speakers, and suddenly you're picking up more vocabulary just because you're using more. It becomes more active, and knowledge builds upon itself. And I think it's important not to forget that doing a little bit every day carries you a lot further than trying to cram it all in at the end.
this I should just do a I don't know, an education podcast and just talk to people about you gotta have a checklist, otherwise you're gonna procrastinate in your life. It's weird. I organize my tasks with like to do, like a checklist sort of.
That's a checklist,
and it works. So there you go. I'll title this checklists with Jim Leitner. There you go. But yeah, that piece of like just getting more knowledge day by day, like other than like cramming it, like not worrying about the entire market in like one day, but just like checking in, and not even checking in, but knowing that you're going to be doing fine, and like eventually you'll see results when, not that you don't put your mind to it, but when you focus on like working on what's important, and then the results will naturally come. I don't know. It kind of relates to stoicism a bit, but
definitely. I mean, I think it's the compounding idea that, the longer you do it, the more it compounds, and the more you also start seeing relationships between different things. So I have a friend in London who did some investment banking and is now very active in his stock portfolio. He just trades for himself. And every day he analyzes one company. Like every day. That's what he does. The same way, like every day you could learn some French vocabulary. Every day he analyzes one company and he reads through their reports and looks at their balance sheet and listens to the latest earnings call with the CEO. And, over the year, like he's really amassed an amazing amount of knowledge about individual companies. And, it's really admirable if you can just have the diligence of doing something a little bit every day. And the other thing that I think is important is to kind of try to keep away from too much noise. Like I get flooded with noise, and they're like just sound bites. Like the way prices change during the day is just noise. Down. Like what kind of edge do I have about whether a certain currency or stock or a bond is going to go up or down? And first it goes up, then it comes down. It's just noise. It doesn't help me make a better decision about what do I believe this stock, this company is doing about creating value, and how is it going to create value over time. So I think trying to stay away from noise is pretty important, and like curating the noise that you're willing to tolerate, right? So kind of looking for certain people that you like to read. I learned something new when I read this research analyst. Okay, so I keep them on the list. Or there's a professor at Yale, Tim Snyder, who writes really interesting articles about political systems. His research deals with communism and totalitarianism, and he's a brilliant writer. And he also has podcasts, and to me it's worth spending the time to listen to him when he puts out a new podcast, because I learn something new, and I want to curate my time so that I don't waste it on noise, because there's just too much noise coming at us.
Yeah, I feel like nowadays that's really big. So many things, like especially with the internet, so many things that you can see online that you may or may not believe in. But yeah, that's really important. Just fishing out what you actually need, because so many people just get like lost whenever it can just be in life when you start off something and you could be worried that like, should I do this first? Should I do this first? Or if you buy like a stock or an asset and you worry about, is the price going to go up? It's just focusing on what you feel like is going to be important and just staying sane. I don't know. That's the best way I can put it, to be honest.
No, you're right. I mean, it's really right. It's curating. It's keeping the noise away, because the noise just gets confusing. Think about it like in terms of investing. You're looking for signals, right? You want to get a signal that a certain company is a great company, or a certain idea is really important, or currency is going to move a certain way. Those are the signals you're looking for. But the amount of noise that has happened in the world has increased tenfold in the last 10 years. You get, like blogs and Bloombergs and messages from brokers and friends calling you, and it's just more and more noise. So figuring out how to stay away from the noise and try to find the same number of signals that you used to find 10 years ago when there was less noise, so it was easier to find those signals, makes really good sense, and it's pretty important.
Yeah. Especially as a teenager, there's just so much noise when you go to school, when you have friends or whatever. Yeah, it's there. That's your wisdom to me, man. Yeah, I gotta thank you for that tidbit.
Thanks for making it to the end of the video. You definitely got something out of it, and we hope that you learned something out of our talk with Jim Leitner. We're super happy to have him, and we hope to have him again on the talk soon. And yeah, thanks for watching. Make sure to like and subscribe, turn on notifications to get notified for our next talk or video, and cheers.